Peter Schultz is the editor of The Winning Secret, a weekly credit spread trading service, and the president of Cashflow Heaven Publishing. Peter has been showing self-directed investors how to trade successfully since 1996 and is nationally known speaker on options trading. He's a popular guest on radio and television shows pertaining to trading. He's the author of The Passage to Freedom, the Options Success Trading Package, The Winning Secret Trading Package, The Explosive Profits Package, and The Greatest Option Strategy on Earth. Peter founded Cashflow Heaven Publishing in 1999 to help individuals obtain a better lifestyle through trading strategies proven to produce exceptional monthly returns. Today, he's going to be showing us how to retire in 5 years or less on $13,000 per month, tax-free. Peter, it's all yours.
Thank you so much, Kevin. I really appreciate that, and it's a real treat to be here. I love the Real Traders webinar events. You guys put together some really great instruction and teachers. So what we're going to talk about, this is me. I'm the founder of Cashflow Heaven Publishing, and what we're going to talk about is how to retire in 5 years or less. Excuse me, on $13,000 per month tax-free. So that's kind of a tall order maybe for some of us. Maybe you might be in a position where you'd like even more than that. Maybe you can get along on less. But I'm going to show you exactly how to do that. And one of the things that's kind of a cool thing when you have a goal, or if there's something that you want to accomplish, and even if it sounds a little out of your reach at the moment, what's kind of cool is to write the goal down and then work backwards and go, okay, this is what I want, so here's where I'm at now. What do I need to do to get there? And the whole purpose of this webinar, the whole purpose of the next 60 minutes here is going to put a really good plan in your hands that you feel like you can do. And it doesn't matter if I can do it or some, Warren Buffett can do it or some genius can do it. What matters is if you feel like you can do it, and with all the ups and downs in the market and as crazy as the economy is and the world events and all that, if you feel like you could put something really good together that's stable, that gives you a really good income every month that you're comfortable with. So that's what we're going to do. And if you've been into a financial planner, if you've thought about your retirement, if you've talked about putting a plan together, you know that it can be a little bit challenging right now. So if you've ever sat down with a financial advisor, what do they say that we need? So $13,000 a month times 12 is $156,000 a year. So what we're trying to do is generate $156,000 a year passively through investment income. So at current rates of return, the 10-year Treasury right now pays about 2.7%. And to get $156,000 a year, your financial advisor is going to tell you need $5,777,000, which is a chunk of money. And if you've got that set aside and it's earning some good interest, my hat's off to you. That's wonderful. You've done a good job financially in life, and you're looking pretty good. If you don't want to settle for that rate of return and you want to go out there on the open market, buy some income stocks, try and get some high dividend yielding stocks, maybe bump your rate of return up to around 5%. To get that $156,000 a year, you're going to need a little over $3 million. And once again, if you've got that in savings, if that amount of money is working for you right now, my hat's off to you. I salute you. I think that's wonderful. But even if you're in that situation, you might want to learn about a method that you feel really confident about, that's very consistent, that pays far better rates of return. So that's what I'm going to show you here today. And for those of us, or many of us, that don't happen to have $3 million laying around to invest, I think this is going to be particularly exciting and interesting for you. So we need to get substantially better than conventional returns, and I think we know that. If you don't have literally millions of dollars laying around, interest rates are so low right now by design. The government wants to keep rates low to stimulate the economy, but it's really, really tough for retirees. So if you're either retired right now, or you're thinking about retiring, or if you'd like to retire in the next 10 or 20 years, I think this is going to be a really, really fascinating webinar. The thing is it needs to be safe and it needs to work. So if you're trading right now And I've been trading, gosh, really active. I've been trading options since 1996. And things were a lot different back then. There was no such thing as weekly options. You paid huge commissions. You know, the bid-ask spreads were gigantic. There was a lot of differences back then. We traded in fractions. And I've been trading a long time, and I really like to trade. Here's the thing about trading. Even if you're really smart, even if you're really good, you have setbacks. And that's sort of the nature of trading. You have losses. You need to kind of figure those out. And trading can sometimes be a little bit frustrating when you're trying to get ahead and make money, especially if it's difficult for you to save, if it's hard for you to set money aside in the first place. To lose it very quickly with an overnight gap in the market, it's just super, super frustrating. So we don't really want to do anything like that. We want to do something where we're really confident, and if we're talking about our retirement money and money that we're actually going to live off of when we get older and we're not able to work or we don't want to work, this needs to be pretty safe. And I think that's really important. So we're going to take a look at that. So in the world of investments, there's always uncertainty. And you know, one of the ways to look at that, a positive way to look at that, is that we get paid for uncertainty. We get paid for taking on a certain amount of risk. So our plan has to have a high mathematical probability of success. And so this particular plan has an 80 to 90% probability of making money every time you do it. And the times that it doesn't work out, we can mitigate with some really good strategies. So when thinking about all the investing you've ever done, would that be at the high end of your probability? And you know, I think that it probably would be. Even real estate, which we think of as an absolute lock, you know, we saw back in 2008, 2009, and even recently in a lot of areas, it still hasn't recovered where it was before. So a lot of investments that we think are absolute no-brainers can get a little bit surprising. So it's really nice to have a mathematical expectation of winning. So I'm an options trader, always been an options trader. I absolutely love options. And if you don't know this, you probably do, but all options pricing is based on the Black-Scholes options pricing model, which won the Nobel Prize for Economics back in 1997. These guys did not create this mathematical model in 97. They created it much, much earlier. And it actually allowed, this pricing model actually allowed the formation of the options exchange back in 1973, the Chicago Board Options Exchange. They finally had a way to price options that was fair for both sides, that worked, that made sense. And if you ever get into this pricing model, you'll see it does make a lot of sense. Now, they've made some changes to it over the years to kind of refine it and improve it. But we're actually taking advantage of this Nobel Prize winning formula to really stack the deck in our favor. And here's one of the really cool things about this. Let's just say that you don't like math, you never did good with formulas, you're not really into science, you're not really into math. You know what? That's really cool. Personally, I couldn't make any sense out of math at all until they started putting dollar signs in front of the numbers, and then math started getting a lot more interesting. So here's the cool thing about this formula is you don't need to know how the formula works, and you don't need to be a mathematician to cash in on it. And the analogy I use is you don't need to know how the internal combustion engine works to drive your car to the bank. And that's exactly the way we use this formula. We're going to stack it in our favor, and I'll show you how we do this. We're going to use a strategy that takes advantage of the Black-Scholes pricing model, and this strategy is based on selling options instead of buying them. And I just want to thank Ron, our last presenter, because I think Ron made a really good case for selling credit spreads. And once you've been around the block, you've traded directionally for a long time, you've done credit spreads, you go, hey, you know what? I like winning on 8 or 9 out of 10 of every trade that I put on. It's actually kind of refreshing. It's kind of cool. So the reason it's important to sell options instead of buying them is you have a much, much better chance of winning. So if you've ever bought an option, so for some of you, maybe you're already trading spreads, maybe you know them forwards, backwards, and sideways. Well, if you do, you're probably going to still learn some things that you don't know. But if you haven't done this, if this is new to you, this is just some really, really cool, it's a really cool approach, and I'll show you why here. So if you've ever bought an option that expired worthless, and if you trade options at all, you absolutely have done that, because it all happens to all of us at one time or another. Have you ever wondered where all that money goes? So early in my options trading career, I used to buy these options on stocks that were taken off, and it was just a surefire winner. And I was trying to figure out what color my Mercedes-Benz was going to be, and I was all excited, and I was telling my wife how much money I'm going to make. And then, a crazy thing happens. The stock reverses. It's not supposed to reverse. All your charts and everything said it wouldn't, but it does. and you lose all your money, and you go, God dang it, if this hadn't happened and that hadn't happened, I would have made all this money, and you dive back in there and do it again. Well, you lose some money trading options a few times, and you're just imagining, is all your money going to money heaven? Where is it going? I mean, it's just disappearing. So it's estimated that just this year alone, over $1,116 billion of worth of options will be traded. That's a lot. And by the way, options are getting more popular every year, and that number increases every year. So it's also estimated that over 85% of those options will expire worthless. So that comes to approximately $949 billion worth of expiring premium, which is an almost unimaginable amount of money. So ask yourself, how much of that $949 billion do you need to retire? So where does all that money go? The money goes to the option sellers. All that expiring premium, if you ever hear about an option that expires worthless, it goes to the option sellers. It doesn't go to the broker. It doesn't go to the market maker. It doesn't disappear. It doesn't get burned up. It doesn't disappear into smoke. One of the cool things about the options market is it's a zero-sum game. With the exception of a little bit of slippage, a little bit of commissions and so forth, for every dollar that somebody loses trading options, somebody else makes. And in 80 to 90% of the cases, the person that makes that money is the option seller. So, if you've never traded options before in your life and you're thinking about getting into this, you should think to yourself, okay, let me see. Do I want to be an options buyer and lose 80 to 90% of the time, but when I win, have the option, the opportunity to make really good money, in other words, win the lottery? Or do I want to get into it and make really good money and win 80 to 90% of the time? And by the way, the 10 to 20% of the time that a trade goes against you, there are things you can do. There's things to mitigate that, and we're going to take a look at that. So for the purpose of this webinar, we're targeting $13,000 per month. But as you'll soon see, that amount can be just the beginning. And the strategy we'll use is called selling credit spreads. And once again, I want to thank Ron for kind of introducing that topic. He did a super, super good job. I just want to go into it in a little bit more detail, because I'll tell you what, if you're a gold miner and you're digging around and you're digging through a lot of dirt and you're just, sticking with it because there's a prize in there somewhere, and then you find this super, super rich vein of gold running through the ground, you work that vein. You could go over and just dig in the gravel 20 feet away from that, but boy, if you've got a vein of gold, you work that thing until it doesn't work anymore. And I've traded credit spreads and options for a long time, and I can just tell you, the credit spreads put money in your account the vast majority of the time. They're like a vein of gold. So what is a credit spread? So if you've never done one before, here's sort of what a credit spread is. A credit spread is simply selling an option and then buying another option to hedge. The option we're selling is more valuable than the one we're buying, so it creates a credit in our account. And just so that you know, a credit's money. It's money you can go out and spend. You can buy a car with it. You can pay your bills with it. You can go on vacation with it. Or you can keep it in your account to build your account up to do even more contracts and bring in more money. So it's just so cool when you trade, and the minute you put on the trade, you get paid. You get money in your account. We're not used to that. We're used to waiting for some hopefully good outcome out there. So it's really nice to get that money right away. So I'm just going to show you a picture, and to do that, I want to grab my little pen here and kind of show you what's going on. So if you're not familiar with credit spreads, here's one that we just did a little while back. So this is Chipotle Mexican Grill, and here's just a really good example. So the stock went down. You can see it went down here, kind of bottomed out. Some really great news came out. The thing gapped straight up, really put in a fantastic day. And if you know anything about gap theory, a gap up like this is really positive. The stock retraced a little bit, and then you can see that it's going back up again. So it really looks like this stock is in pretty good shape. It's starting to climb. So what we're going to do is we're going to put on a really high probability credit spread. So we're going to go way down here. We're going to go below support, and we're going to sell the 515 put. And we're going to get for that, we get $1.55. Now, the reason that we buy this one is to hedge, is to protect ourselves. So we go down and we buy the 510. What that means is the most amount of money that we can lose is just the difference between these two strikes minus our credit. So we buy this put for $1.05, and the difference between these two is 50 cents. So that's the amount that hits our contract, that or account. So that's 50 cents per contract. So if you're doing, so you multiply by 100. So that could be, $50 if you're doing one contract. If you're doing 10 contracts, it would be $500. If you're doing 100 contracts, it could be $5,000. So don't, just think that, 50 cents is a small amount of money. You can ramp that up depending on the size of your account. But let's just take a look at our rate of return. So a 50-cent credit divided by, now the most we can lose here is $5 minus our credit. So the most we can lose is $4.50. So 50 cents divided by $4.50 is 11%. And in this particular case, this was just for 2 weeks of time. Now, if you're a big-time trader, you like to use a lot of leverage, and you go, well, Peter, gosh, why are you even wasting my time? I mean, gosh, I'm used to putting on an option trade, and in a couple of days I double my money, and I'm used to 50%, 100% profits. And I'm thinking, you know what? I'm 100% sympathetic with you. I love doubling my money overnight. But what I've learned after trading options and just being a trader for over 20 years is what we're really concerned about is our probability of winning. So, I mean, a good example is why don't you go out and buy lottery tickets? Well, I mean, heck, you could make $10 million and you're only spending $1 or $2 on the ticket. Well, the reason is, is that your probability isn't real high. So I would rather take my 11% with an 80 to 90% probability of winning than have a much bigger prize with a very low probability of winning. So that's why, especially for any kind of a retirement strategy, this thing makes so much sense. So here's another cool thing that you can do. You can also go up and you can say, this thing gapped up, but it's not really going crazy. It looks like it's kind of going sideways. Why don't we, bring in more money and sell a call spread? So we jump up here and we sell the 570 call for 95 cents. We buy the 575 call right here. So we sell this close one. We buy this one to hedge, the top one, and we get a credit of 55 cents. Well, now we have $1.05. So if you look right up here at the top, we have $1.05 credit, and we've actually reduced our amount of risk because now we can only lose $3.95. That's the max we can lose. So we have $1.05 credit divided by 395, and all of a sudden we're getting a 26.5% rate of return. Oh, in this case, it wasn't really 2 weeks. This happened to be 8 trading days at a time. This is an actual trade we did. It's one that I recommended to the subscribers, and it worked out really well. As you can see, it expired right here, right in between our two spreads, and when that happens, you keep all the money. So it's one thing to create these spreads. And wait a second, before we move on too much, I just want to make a point. If you're familiar with credit spreads, if you've traded them before, you've heard about them maybe a few years ago, you read a book on one or saw a webinar or whatever. A lot of the time when people talk about credit spreads, they talk about just a general rate of return is around 5% per month. Things have changed a lot. Even when the VIX is low, and it doesn't look like there's a lot of premium for spreads, you can get a lot more money now with some different tricks I'm going to show you here in this webinar. But one of the things is just the advent of weekly options, and I don't recommend necessarily buying or selling options on the week they expire, but what weekly options have done is on certain underlying assets, they give us an expiration every Friday, so we can really pick our expiration date. So you can make a lot more money with these spreads than you used to, and you can still keep your probabilities really, really high in your favor. And that brings us to this question: how do we know that our chances of winning are 85 to 90% or better? Well, one of the things about options is they're based on a mathematical formula, the Black-Scholes pricing model. So whenever we sell an option, we can instantly see what the odds are that it will expire worthless. And so here's the thing. Here's the trade that we just put on. So here's Chipotle Mexican Grill. We're over here on the call side. So we sold, if you look here in the lower left-hand corner, we sold the 570. We bought the 575. So you always base it on the one that you sold, and we see that we have an 89.93% chance of winning. That's the probability that this thing is going to be OTM, or out of the money. What we're looking right here is the Thinkorswim trading platform. And if you happen to have Thinkorswim, here's how you do it: is you go to your layout and there's a little corner down here, this little gold corner, and you click that, and it gives you some options. What you want is you want to set your screens up or your columns here for implied volatility, probability of out of the money, and your delta, and that tells you a lot. So here we have about a 90% probability of winning, and then we go up here, and this is the trade that we put on the put side. We sold the 515, we bought the 510. Over here we have a 92% probability of winning. So you average these out between the two of them, you have about a 91% probability of winning. You know what? I'll do that trade at 26, 27% for 8 days at a time. I'll do that trade all year long. And it will blow you away how your account builds up. The miracle of compounding interest. So these probabilities do really play out over the long run, which makes for great odds. Plus, there are adjustments we can make to make the trades even better where they go against us. So here's the thing with credit spreads. If you know anybody that does credit spreads, or if you've done them yourself, here's the typical thing people say. They go, oh yeah, credit spreads are great. You know, it's fun to collect that premium and all that, but what if the trade goes against you? You know, you can win or you can lose a lot more than you can win. Boy, that's really scary. I don't like that. So the whole key to credit spreads is about 8 or 9 times out of 10, you're just going to sit back. We watch the thing expire worthless. We don't even have to pay any more commissions. All the money just ends up in our account. You could take a nap and you know, have the trade go in your favor. About 20% of the time, 10 to 20% of the time, you're going to have to do something. So if the trade goes against you, if your trade gets threatened, and you always hear about this term with credit spreads, is adjustments. So I know it sounds kind of crazy, but I actually welcome the occasional trade that needs to be adjusted because it says two things. Number one, we're selling close enough to the underlying. In other words, we're selling close enough to the stock to have to adjust once in a while. And the reason I like selling a little closer to the underlying, especially on our aggressive trades, is because we bring in a lot more money the closer we sell. If you sell further away, you get less money, but the trade is safer. So we're always looking for that sweet spot where we're getting paid really, really well, but the trade still has a high probability of winning. So the other thing is we have the means to adjust our way out of almost any situation, and that means you feel powerful and confident in what you're doing. And so once you learn these adjustments and you learn these counter moves, you know, you're not so scared anymore. I don't know if you remember back when you first learned how to drive a car, and it's pretty scary, and there's all this traffic out there, and cars are coming at you and everything, and maybe somebody's not paying attention, and they come a little bit over in your lane, and you just freak out. You know, that's not supposed to happen. You know, what do I do? Well, after you've driven a little bit, you realize, oh, I just pull off to the side of the road. I pull off to the right or whatever. I give them a little bit of room, and then I just carry on, and you don't freak out like you used to because you know what you're doing. You have confidence, and that's what learning these adjustments is all about. Once you learn them and you kind of know what to do, and it's just automatic, yeah, you don't sweat it anymore. You don't fret. You just know how to handle the situation. Here's a really good example. Adjusting your spreads means to close a spread that is being threatened and then open a new position to bring in more money. And all it takes is a few mouse clicks, and it's very effective. So look at this chart on the right here. The stock is hovering around 169, right in here. So we sell the 174, 175 call spread and the 163, 162 spread, expecting them to expire worthless. We got a really nice sideways channel here. The stock has a ceiling and a floor. We think, based on everything that we've read and that we've seen, the thing's just going to continue sideways. But what happens in the stock market, you guys and gals? We get surprises all the time. Stock market's kind of crazy sometimes. And this thing just dropped, okay, right after we put on the trade. And here it is. We don't let it ever go through our spread, but it's getting pretty close. And we realize, you know what? We should do something. We need to adjust this thing. And so what do? We close this spread right here. And that means buying back what you sold and selling what you bought. And now you're out of it. You have no more risk. The only problem is it takes money to close that spread. And as close as this stock is getting to your spread, you know, it takes a chunk of money to close it. But it's important that we do that because we eliminate our risk. And we also don't want to lose. So we're sitting here going, okay, how are we going to get that money back? What we do is we sell another spread here. We sell another spread here. We take in a really nice chunk of cash that completely offsets our cost to close and actually puts a few more dollars in our account. And then we're off on our merry way, and the stock can kind of do what it wants again for a while. So that's an adjustment. That's a really simple one. It's a common one. And we've got a bunch of adjustments, and I want to teach them all to you. Because if you're going to do this strategy, I want you to be so comfortable, and I want you to really feel like, hey, in just about any situation, I know what to do. So being able to adjust our positions and having the probabilities on our side is critical for the success of our plan, along with good chart reading and looking forward at the fundamentals driving the market. A lot of the things that you're already doing with your trading right now. But we want more than theory. We want a proven plan, a proven path to follow. So has anybody else actually done this with good success? So yes, we have. So I've been trading credit spreads really actively since 2003, and finally I just decided this thing needs a wider audience. I want to do this with a group of people and make some money together. So we started the advisory for credit spreads in 2010, and we've got a really great track record which we publish publicly, and you can go to the website cashflowheaven.com. You can look under the winning secret and you can see what our track record is, and I'm really proud of it. We do great, and I want to do great for you. But that's just me. Is anyone else? Can anybody else do this? Could you do this? In other words, is this method duplicatable? So here's one of our subscribers. I love this guy, Bob Malota. I kind of fall in love with our subscribers. I love these guys that are older than me, that are really smart, that are just really good at that, having a fantastic income from the markets. I consider them the retirement winners. So here's what Bob Malota sent me. He says, as promised, here are my trading results for the year. I very nearly had an undefeated season of my high probability credit spread trading this year. Unfortunately, I suffered my first loss for the year 1 week ago. So can you imagine trading for a whole year and having one loss for the whole year? So anyway, he says, my record so far for the year is 13 put ratio spreads, all done for credit, 8 iron condors, 2 of which consisted of 3 credit spreads because I closed the winningest side and reopened it closer to the money, and 5 single credit spreads, 1 of which was the above mentioned loss. So that amounts to 25 wins and 1 loss for a 96% win ratio. And I made a total of $19,126 and averaged $1,594 per month, and averaged a return of 9.5 per month, including all commissions and losses. So this is just a kind of a guy out there just doing this. He does some of his own, and he's a subscriber, and he does some of our spreads as well. And I just love Bob, and I love getting feedback. And what I think is so cool is people are actually doing this, and I think it's actually the best kept secret on the planet. All these really shrewd, smart, retired folks just, doubling their income or whatever Social Security is giving them, just really doing well out there and keeping their mind sharp. So I got another one that I'm a little closer to. This is my cousin Ralph, and he's out in Chicago, which is kind of the capital for options trading in the United States. So after trying trading directional puts and calls with mixed luck, my cousin Ralph started trading this strategy, and he had such good results. This is all he does now. So when he first started, his wife was skeptical, and some of us that have wives, or you wives that have husbands, they get skeptical when you start talking about options trading. So his wife was skeptical, so he asked her, how about if I put an extra $1,000 a month in your purse? And so now Ralph makes several $1,000s per month trading this strategy, and his wife isn't skeptical anymore. And that makes Ralph happy, and that makes his wife happy, and that makes me happy. So I love getting these stories from subscribers. I'd actually like to get a story from you once you get going. So this gal right here, she's the absolute queen, and I want to introduce you to her if you don't know about her already. Those are regular guys making a good monthly income, but there's a woman named Karen that really took this method to a new level. She started trading with $100,000 of her own money using this strategy, and she even used the Thinkorswim platform to do it. So she was an accountant for many years at a big corporation. Really wanted to branch out on her own. She was tired of the corporate thing. She knew numbers. One of the things that I notice about people that trade credit spreads, a lot of the time they're engineers. My cousin Ralph is a chemist. Karen was an accountant. The people that know numbers and understand probabilities, they love credit spreads, and they tend to do well. You don't have to be a mathematician. You don't have to be an engineer. All you got to do is just follow in the footsteps of some really smart people, and you'll make the money. I mean, the money will come to you. So Karen I absolutely love, and here's why. She's a big thinker. She was so successful. Wealthy individuals and institutions started giving her money to manage. So she started gathering more money using these strategies. And eventually she was managing $95 million. Over the course of 3 years, she made $41 million using this strategy, and she's still trading today. So I want you to check this gal out on your own, because I just think it's so unbelievably cool. There's a YouTube video where Karen is interviewed by Tom Sosnoff. So he's one of the founders of Thinkorswim. Tom's a fantastic guy. He's a total kick in the pants. He's really, really sharp, but he's also got a great personality. And he has this show called Tasty Trade on the internet, and he interviews traders. And the reason that Karen came to his attention is because when he was running Thinkorswim, she was trading millions of dollars worth of contracts, and so they just naturally kept an eye on her, because they watch the big traders to make sure that, you know, nobody does something crazy to get the brokerage in trouble. And she came to his attention, and he just could not believe what she was doing. So to find that video, and so he ended up interviewing her. And these interviews are fabulous. They're fantastic. So to find that video, just Google Karen Super Trader Tasty Trade. So the first video is 24 minutes and talks about her making $41 million, and the second one is 51 minutes and talks about her making $105 million over a longer period of time, and they're both pretty inspirational. Now here's what I want to say about strategy. She started off doing credit spreads, the exact strategy that you're learning right here, and the exact one that I do and make the majority of my money with, and the exact strategy that all these retired folks all around the country are supplementing their income. And by the way, when I say retired, you don't have to be 65 or 75 years old. If you're 35 years old and you have some savings, you have a decent size account, and you want to start doing this, you might end up retired a lot earlier than you think. And personally, I like to work. I think working's great, but it's a lot more fun to work at what you want and something that's your idea than for somebody else. So if this method can get you some freedom, man, I'm all for it. But anyway, Karen started off doing credit spreads, and eventually she got so much money and she got so much dispensation from the broker, she could start selling naked. So she started selling puts and calls way out of the money, had a very low probability of ever becoming overrun. And so now she just does, I think they call them naked strangles. She sells naked strangles. So she doesn't buy the hedge. But for us and everybody else, I'll tell you, if you're unhedged, your margin requirement is through the roof, and we really want that margin of safety for me or for you or for anybody else that's doing that. So we actually do spread trades. So she's modified her strategy, but it's the same thing. It's the same basic concept. She's selling premium, she's collecting the money, the premium is expiring worthless, she keeps all the money. And the neat thing about the markets is they're so darn big and they're so darn scalable. She's able to make $41 million in 3 years and $105 million over a little bit longer period of time. So we're talking about $13,000 a month. I think $13,000 a month will make most of us pretty darn comfortable. You know, you can live pretty comfortably on that if you keep your trips to Starbucks to a minimum. But I just want you to know that there's a lot more money available. So if you're a big thinker, it's there for you. So. These videos are great for watching. Karen talks about selling about 56 days of time for optimal returns, but these videos were made in 2012, so she's talking about what she used to do. And that was before they made the changes in 2012 to weekly options. So the way weekly options used to work is they'd create the option that week. So they'd create it like on a Friday morning or Thursday, and then it would expire the following Friday. So what they did in 2012, so you could just get into it that week. So what they did in 2012 is on certain things like the SPY, the IWM, certain underlines, they would make options expiring every Friday for the whole month. So what's cool about that, what's incredible about that, is you can literally pick the point on the time decay curve you want to be on. So let me just get out my little red pen here, and here you can see on the time on the bottom here. So this is this is expiration right here. This is the goal line, 0 days. That's when your option is worth nothing. So you can sell 30 days of time, you can sell 60 days of time, you can sell 90 days of time, you can sell 120 days of time. Here's the lesson that I want you to take away from here about time decay. So this is 4 months out, and time decay, it decays very slowly. It goes down in value very slowly. It's almost flat. In the third month out, it starts to steepen up a little bit. Now, in the second month out is when it starts getting interesting. It starts off kind of flat, and then it gets steeper as you get towards front month. So what Karen was talking about is selling 56 days at a time. So I'm going to just put a hash mark right here. This is when she would sell, right here. And she determined mathematically that they would get the most amount of money for the shortest amount of time, and so that's what she does. Okay, but that was before they made the changes to weekly options. Now, see, all she had available to her was expiration on the third Friday of the month, the monthly option. So now it's so much cooler because it's so much more flexible. So what we've determined is, based on a lot of mathematical studies and a lot of actual real life experience, is we sell about 2.5 weeks at time. We sell right in this sweet zone right here. And if we get the right stock with the right amount of premium, we can make really good money. And as you can see, the minute we take in that premium, it starts to decay. And the time decay is so steep, and you're only talking about hanging on and having your money exposed for about 2 to 3 weeks at a time. And it just goes so fast, and all of a sudden expiration comes and goes. Now, the beauty of that is it decays really fast. So, that's really good, because the object here is to sell something of value that decays really quickly down to zero. But the other really cool thing about this, and this really juices your rate of return, is you get your money back that much quicker. So instead of having your money tied up for 2 months, or even if you sell a monthly option and have your money tied up for a month, can you imagine if you got approximately the same rate of return every 2 weeks? What you've done is essentially doubled your rate of return. And that's where we're at right now. What I tell people, and it's absolutely true, is there's never been a better time to trade options. Commissions are lower than they ever have been. The bid-ask spreads are narrower than they ever have been. Options have gotten extremely efficient ever since they introduced penny-priced options. And they've now got, you can, on certain underlines, you can pick your expiration Friday, because certain underlines have an expiration every Friday. So things have just never been better. So Karen was able to make millions of dollars before this change. Think about how much better it is now. So we're taking what Karen has done as the inspiration for a new program designed to get anyone who follows it retired within 5 years. These trades will be more conservative than our usual spread trades because we're willing to accept lower returns for a higher probability of winning. Our typical spreads yield anywhere from 15% to 30% every 2 weeks. But what if we went for much more safety and targeted just 10 to 20% every 2 weeks? Over the past 3 months, we've actually been averaging closer to 20% on our retirement trades. But we have to factor in occasional losses and losses in the market. Even though we have adjustments, even though there's things we can do, you have to accept that occasionally you'll have a loss. And we've got commissions, and we need to set aside some cash for buybacks. So these adjustments take cash. So that money's sitting there in cash, and it's not being fully utilized until you put it to work for rollouts and so forth. But the good news is we're averaging 2 trades per week instead of per month. So what can we expect? So what we've typically been doing is about 20% every 2 weeks. So, just what do you think you could make with this? I mean, what realistically do you think? Do you think, boy, if you had a few losses, do you think you could do, and you had to pay some commissions, do you think you could do 15% every 2 weeks? I mean, do you think that's possible? Let's cut that in half. We've been doing 20%. Let's say we just can do 10%. And, and that factors in a lot of losses. That factors in a lot of things going wrong. Let's say that that's even too extreme and we just take it down to 5%. What I'm trying to do here is I'm trying to make this, so if you're one of these folks, and I know how you feel, I've been there myself, where you think, oh yeah, this sounds really good, he makes it sound all really good, but the minute I get into it, that's when the market drops off, or that's when, the thing doesn't work anymore. If he's getting 20%, I'll be lucky to get 5%. So let's just say that, yeah, all you can do is 5%. That's all you can do. And let's just say you can't even do 5% every 2 weeks. I mean, you're so terrible at this, and your timing's bad. You try, and it just doesn't work out for you. All you can manage is 5% per month. That's the best you can do. So what does that look like? Well, The good news is getting 5% per month is still very impressive, especially when that money's compounded. So if you want to get excited about something when you get off this webinar, get out a calculator, take whatever you have in your account and compound it by 5% a month over the next 3 years or so and see what you have. If we're going to really build up that account, we want to have as much of our money working for us as possible. In other words, we want to compound our returns in a tax-free environment to get all our money working all the time. Plus, wouldn't it be nice to be able to take that money out tax-free when it's time to live off of it in retirement? Well, of course it would. You know, the only people that don't complain about taxes are people that haven't made very much money. If you made some really good money in your life, it is astounding how much money you have to pay. And it's not just federal taxes, it's state income taxes, it's all kinds of taxes. I mean, we pay a lot of taxes today. So we're going to put our money in a special account that can build to infinity without having to pay any taxes on the profits ever. And this is one of the aspects about this program I love the most, because if you paid a lot of money in taxes, you are probably ready to have some tax-free income, and you probably deserve it. So that special account is called a Roth IRA, and that's where we're going to be doing these trades. So I'm just going to, if you know about Roths, you already are probably a believer. If you don't, I'm going to just tell you the characteristics of a Roth, and they're going to blow you away, and you will not believe that Congress ever did this for us. I mean, it seems like they're always trying to get every little penny out of our pockets. Somebody did us a huge favor by putting together a Roth. So first of all, contributions are not tax deductible, you know, like a regular IRA, but I just want to make a point. And the point is that the money that you're already putting in your investment account, whatever it is, that's not tax deductible either. That's after tax income, whatever you have set aside, whatever your savings are. So this is absolutely the same. There's no difference there. So you can contribute up to $5,500 per year under the age of 50 and $6,500 over the age of 50, because they want you to catch up a little bit. And by the way, if you have a spouse, she can contribute too, so you can double it up and put it in an account. Direct contributions to a Roth IRA may be withdrawn tax-free at any time. So all that money that you put in there, you can take it out. There's no penalty. All they're concerned about is the buildup. Why? Because you've already paid taxes on it. So the government isn't going to gig you again. So earnings may be withdrawn tax-free and penalty-free after the age of 59 and a half. I used to consider 59 and a half pretty old. I do not consider it very old anymore. I mean, that's a young guy. I mean, there's guys out there that are rock climbing and surfing at the age of 59 and a half and running around in convertibles and chasing girls. So, and you gals too. I mean, 59 and a half is nothing, especially not today. So distributions from a Roth IRA do not increase adjusted gross incomes. So those earnings do not increase your tax bracket on your other income. Think about that one for a second. So let's just say you're taking $13,000 a month out of this thing in a few years, out of your Roth IRA. It does not affect your income. I mean, it does not bump you into a higher tax bracket. That is unbelievably cool. The Roth IRA does not require distributions based on any age. You never have to take any money out if you want to just keep it building it up. All other tax-deferred retirement plans require withdrawals by 70 and a half. Unlike distributions from a regular IRA, qualified Roth distributions do not affect the calculation of taxable Social Security benefits. So if you're getting all your money from a Roth, let's say you're getting $13,000 a month, or let's say you're getting $20,000 a month, you can still get your Social Security like you always did, because that money doesn't show up. It's like you had zero income. So assets in a Roth IRA can be passed on to heirs. That is unbelievably cool. So there is some qualifications. So, you know, there's this big war on the rich in this country, the war on the wealthy. You know, they're just these horrible, awful, evil people that I would like to be. It's kind of ironic. You know, I used to think that we celebrated success in this country. Well, they kind of want to punish you if you do too well. So here's the deal. Single filers, up to $110,000 to qualify for a full contribution. If you make more than that, if you make over $125,000, you cannot do a Roth. And joint filers, up to $173,000 to qualify for a full contribution. And if you make over $183,000, that's like you and your spouse, over $183,000, you are not eligible for a Roth. Well, here's the good news. If you're making more than that, if you're making more than the minimums, you probably have some good money set aside and some good savings. So the good news is you have more money to invest, and that's fantastic. The bad news is you can't do a Roth. So if you make under these amounts of money, you can do a Roth. The government wants you to do it. You're fully encouraged to do it. This is not some fly-by-night, weird thing where you're stashing your money in some foreign country. This is all in the IRS tax code. If you have a financial advisor and you go get a hold of them and ask them about this, they're probably going to love the idea of a Roth, especially, and this is the key, if you have a method or a strategy that can produce some really fantastic income and a really good buildup. And we do. And we're proving that every single day we put on a spread trade. So the amazing thing about a Roth is that you can build up any amount of wealth in the account you want. And as long as the distributions are taken after the age of 59 and a half, the money you take is completely tax-free. That's the takeaway. So if we were averaging just a 5%, now keep in mind we're doing 20% every 2 weeks. I mean, sometimes we do 30%. We are making really good money on these. But let's just dial it back. Let's just lower those expectations. Let's forget about making money every 2 weeks. Let's just say 5% monthly. That's all we can do. We have some losses that offsets our 20%. I mean, gosh, this is the best you can do is 5% per month. I guarantee you can do better. But let's just say this is all you think you can do, is 5% monthly. And we are only using the money we can put in a Roth. What kind of account can we build up in 5 years? Would you say that that's a relevant question? Would you say that's a question you'd want to know? I mean, if you're going to learn something new, if you're going to change your trading strategy a little bit, is there a reward waiting for you at the end of the rainbow? Is it worth your while to pay attention? Well, gosh, it doesn't cost us anything to get out a little calculator and take a look. So let's just see what it looks like. At just 5% per month. So contribute $6,500 per year into a Roth IRA for 5 years at a 5% per month compounded return. And this is what your returns look like. At the end of year one, you have $11,673 and a $584 a month income. Not fantastic, but you know what? It's good. We have faith it's going to get better, so we leave that in there for the second year, and oh my goodness, we've got $32,000 in the account. It's building up, and we've got a $1,600 a month income. Pretty, it's getting there. Just by year 3, you don't even have to wait till year 5. By year 3, you've already got $70,000 in there. You're getting $3,500 a month, and you're getting that money tax-free. Do you know how many people in this country work a 40-hour plus per week job and take tons of crap from their boss and have to commute long distances and have to be away from their kids and have to stress out for $3,500 a month net? Because to get $3,500 a month net tax-free, you need to be making, I don't know, $4,500, somewhere in there. So just by year 3, things are looking pretty good. By year 4, things are looking kind of incredible. You've got almost $138,000 a month to work with in your account, and you're bringing in about $6,900 a month. By year 5, it gets crazy. Over $250,000 in your account, and just a hair under $13,000 a month. So is it possible? Can you do this? Well, if these numbers look a little bit big to you or they look a little unattainable, I just want you to remind you that Karen made $41 million in 3 years with obviously a larger amount of money, but this is very doable. And you can sit down with a calculator and the math works. Well, now, if you're curious of what it looks like past year 5, you don't ever have to take the money out, so it's possible to just keep building it. So just for fun, let's take a look at what years 5 through 10 look like. And this is crazy. This might just kind of beyond your imagination, but year 6, $22,000 a month. Year 8, $78,000 a month. Year 9, $141,000 a month. Year 10, it starts getting a little bit wild. If this is beyond your realm of what you think is possible, if you don't think this is reality, that's fine. We can move on from here. I just want you to know that it is possible, and people out there are doing it. Professional money managers. Karen's not the only one using this strategy. This is an incredible way to make money. So for now, let's just go back to our original 5-year plan. The very next month after your 5 years is up, you have $272,000, and at just 5%, that amount brings in $13,000 $614 per month, tax-free, and we are there. Now, if you'd like to get here like sooner rather than later, every journey starts with a step. And you know, the cool thing about this journey, it's not hard. It's not difficult. I totally enjoy it, absolutely love it. I have a feeling that once you start trading this way and you get used to winning on 8 or 9 out of 10 trades, and then you only have to adjust 2 of them, you're going to love this. It's not a tough journey at all. Now, I realize we don't live in the calculator world, we live in the real world, and in the real world, we won't get exactly 5% every month. Sometimes there'll be setbacks, and sometimes we'll do a lot better, and frankly, I'll tell you, based on our experience and our track record, most of the time we do better. But the point is, the probabilities say the plan will work, and it is working right now. And I opened a Roth IRA at Thinkorswim, and if you let them know you have options experience, they will let you sell credit spreads in your Roth IRA. And if you decide to come along and do this with me, I'll even set you up with an account at Thinkorswim with the inside track to discounted commissions, and that gives you a huge advantage. And the reason commissions are so important on spread trades is because we have a lot of legs going on at one time, so commissions are important. We're doing 2 trades per week. The first is our usual more aggressive, higher return credit spread, but our second trade is a Roth retirement trade. It will be a little lower return, but safer. We'll be shooting for a 15 to 20% or better return with an 85 to 90% probability of winning. The 2 trades can be traded in 2 separate accounts, and have you seen the buildup can be pretty amazing. So this is a train you absolutely don't want to miss. I'm so glad you're here, you're listening. I just want to encourage you in the strongest terms possible to take advantage of this. I love this. I love what we do. I love getting emails from people all around the country and all around the world that are doing this. And it's really fun to see people build up their accounts, particularly if they've kind of had hit and miss luck with their trading in the past. So it's super important to me that you're successful with this, so I want to make sure you've got absolutely everything you need. So to make sure you have a really good understanding of how the strategy works, you'll get a complete video presentation called How to Sell Credit Spreads for Fun and Profit, and it is impossible to watch this presentation without being enthusiastic at the end of it. And don't worry, I don't sugarcoat it. I show you the ups, the downs, I show you the dangers, I show you the good things, and I show you all the probabilities and really what to look for and how to do it. But I'll tell you, it's a really, really, really cool way to make money. And it shows you step by step how credit spreads work, why they work so well, and how they can work for you. And I've also put together this just really outstanding package. It's really comprehensive. I used to sell this live events. I traveled around the world. I spoke on cruise ships. And the people that bought this are still trading it and are still delighted today. I still hear from them, and I sold this regularly for $2,500, and people were delighted to get it. And this package is super complete. You'll see how wide of a spread to sell, how much time to sell, what to look for if the stock gets close to your spread, how many spreads to have on one time. It's super, super comprehensive. You get a 161-page downloadable ebook complete with color graphs, charts, pictures, everything you need to start trading profitably and stay that way. Plus, you get a 15-chapter video series that walks you step by step, shows you what to do. You can hear and see exactly what to do to start generating this income. Plus, you'll get 14 separate audio files, completely different, you can listen to and download to listen to in your car or on your iPod, your MP3 player. You'll also gain access to our archived webinars so you can discover new strategies and ways to improve your returns and limit your risk. And you'll have access to all new webinars for lifetime. It's a one-time fee. You never have to pay any more as an owner of this package. It's the best credit spread education out there. I've seen them all. I've read all the books, and we just put together something really incredible. That's why we could sell it for $2,500 a pop. Plus, you'll get 3 videos that show you how to set up automatic orders with our favorite broker for spread trading. These are the videos that will show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. And this is the really cool thing. This is our subscription service, and I'll show you what to trade and how to trade it. You get 2 new high probability trades every week. I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. This is a comprehensive, you get it. I email you, you can log into the site, I show you what the market's doing, I give you all the lowdown on 2 new trades. You'll love this. This is our subscription service. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. You know, when we created this, people wanted to buy this by itself so badly. I mean, people love the idea of the weeklies. They want to trade the weeklies. This 10-module video course, it really shows you what the weeklies are about, what the time decay is all about, what to watch out for, how to trade them, how to put on the trades. This is a fantastic course. We priced it at $150 all by itself. People absolutely love it. And to make sure you get everything going for you possible, you'll also get a special link to open an account at the best broker in existence for this strategy, and that's thinkorswim. And once that account is open, we'll put you in touch with our special contact there. We have an individual there that we work with exclusively at TD Ameritrade to get you special commissions rates set up just for this program. So at thinkorswim, they know that spread traders trade more contracts, and they are willing to give discounts for people that trade a lot of contracts. So I want you to get in touch with our special contact there for special commission rates. So I want you to come on board so we can trade this plan together, invest what you can, and prove to yourself how well this works, and then watch your account build. And to get everything we've talked about and to put your feet firmly on the path toward a more generous and secure retirement, go to, and here's the URL, and hopefully they'll put it up there in a clickable link for you. It's therealtraderswebinar.com/cashflowheaven. I've got a special for you that it's going to blow your mind. Our subscription service is $97 a month. People pay that delightedly because of what they get out of the service every month. And we've got that educational package that we sold for $2,500. We've discounted it down in live events down to as little as $1,250. You're going to get an outrageous deal on that as well. I'm not even going to tell you what it is right now. I want you to actually go to the link and see for yourself what it is. But it's a really incredible deal. I wanted to do something special for Kevin and Mark for having us here. I wanted to say thank you to them and to you. And it's a really, I think it's a deal that you're really going to like. And I just want to take a quick, we've got about 60 seconds here. I'd like to, if I can, answer some questions. So, Peter, I have an account at Toss now, don't want to close it. What else would you recommend for a separate Roth directed account? You know what? Open your Roth account at thinkorswim and get a hold of us here at the office and get a hold of our contact there and see if our contact can get you some lower commissions. Do we have any other questions? I'm just trying to look at the question box and see what I can see here. And you know what? We're kind of wrapping up here. We're running out of time, so I can't see the questions here very well, so I just want to say thank you for being here. If you come on board with us, I will tell you this. We have fantastic customer service. We don't have people that just answer the phones. I've got some incredibly talented individuals here that are going to be taking your phone calls. One of them, Alicia, she's got a degree in finance, and she is really, really good with numbers. She knows this strategy. We want to support you every way we can. So call us up anytime that we're available, and we'd be happy to answer your questions. I want you on board. That's one of the reasons we've offered a really good package here today, and I want us to make some money together, and I want you to have a secure retirement. So if you want to do some speculative trading, you know, do it with 10% of your money. Take the other 80 or 90% and do this, and I think you'll be delighted. So I want to thank Kevin and Mark for having me. I want to thank you for being a really, really wonderful group, and you know, and I want you to come on board. I want you to be with us. So I'll look forward to seeing you inside the site. Thanks so much.
All right, Peter, thank you so much. Guys, who else wants to retire in less than 5 years? I know I'm up. So guys, just want to repeat the link. So if you go to realtraderswebinar.com/cashflowheaven,